Hello students, welcome to Accounting Explained at AccountWise Academy. This is Latha Venkateshwaran. Have you ever wondered how businesses decide which project is truly the best investment? Today, let's discover two powerful tools, internal rate of return and modified internal rate of return, that experts use to make smart financial decisions. Dear students, unless you are thorough with the concepts of IRR, NPV, and time value of money, you will not be able to fully understand the MIRR concepts explained in this video. Please watch my previous videos on IRR and NPV, and only then come to this video on MIRR for the best learning experience. Let's learn briefly about IRR now. IRR means internal rate of return. It is the discount rate that makes the net present value of a project zero. So it is a rate or the discount rate at which the NPV will be equal to zero. IRR balances your investment and returns over time. It means your investment will be equal to the returns at this discount rate of IRR. See here, cash out investment. This is your cash outflow, and in the project cycle, you will get cash in returns. Okay, so IRR is a discount rate at which your cash outflow will equal to the cash inflow. Let me explain about IRR with this simple balance. Okay, your initial investment on one side, so this is your initial investment cash outflow, is balanced by your future returns. That is the returns inflow. IRR is the rate that makes these cash flows exactly even. So it will be even over the period of the time, that is over the life of the project. So your NPV will be equal to 0. Let's see the acceptance rule for IRR. If IRR is greater than required rate of return or the cost of capital, you can accept the project. Required rate of return or cost of capital will always be denoted by the alphabet K. Okay, remember that. And required rate of return and the cost of capital will be given in your question for your exams. You can compare the IRR which you have calculated with that. Okay. Next, reject IRR if IRR is lesser than required rate of return. If it is greater than required rate of return, accept. If IRR is lesser than the required rate of return, reject. So this is the rule. Now I'm going to give you a tip. Higher the IRR means better returns, meaning more the IRR, more the returns. Okay. Now let's see an example. If IRR is 13% and the required rate of return or cost of capital given to you in the exam is 11%. Will you accept or reject the project? I'll give you a few seconds. Yes, you will accept the project because IRR is greater than the cost of capital. Limitations of IRR assumes money can always be reinvested at the same IRR. Here, money means profit which you have earned from the project. If you are going to earn profit from the project, you are not going to keep the money idly. Usually, the business will invest it somewhere. Here, when you are using IRR, we assume that this profit which you have earned from the project, right, it will be reinvested at the IRR discount rate. That is very unrealistic because the IRR will be the highest rate which we have calculated, and at this rate, we know that NPV is equal to 0. So we want only our profits to be invested at the IRR rate. But the market situation might be different. Market rate might be lesser than the IRR rate. So that is why we call the assumption of IRR as unrealistic. Now, next point is multiple answers possible for complex cash flows. When you have complex cash flows, then you will get multiple answers. If you have seen in our previous video, we would have used formula to calculate IRR. If we had not used a formula, we would have used trial and error method to find out this discount rate of IRR, and we would have ended up with multiple answers before getting the correct discount rate where NPV is equal to 0. See, this is very complicated method, no? Next, not always best for comparing projects. When there are multiple projects to be compared, and out of which we are going to select one of the projects, then the decisions become tricky if you are going to use IRR. To overcome the limitations of IRR, MIRR is used. The other name is modified internal rate of return, or you can call as a realistic return. Okay, now MIRR solves all IRR's flaws. MIRR has two assumptions. First, we will see the assumptions and then explain the assumptions with this picture. Okay, it assumes reinvestment at company's real cost of capital and outflows are financed at the actual borrowing rate. Now look at this picture. Assume this box as your project and it will be financed by the outflows. Outflows is nothing but your initial investment. Okay, we assume the initial investment which we are going to bring in from borrowing outside, and that rate will be at the market borrowing rate. Whatever is the market borrowing rate for lending money, that will be used. So this we are going to pay outside. That is why the arrow is pointing outside. Okay, the interest which we are going to pay outside, and with that we are going to get our initial investment. That part is clear, no? Next we'll come to the returns which we are going to get from the investment we have made for this project. Returns are nothing but your profit which you are going to earn. We assume that this profit will be reinvested outside, and the rate for the reinvestment you will be expecting will be at the company's cost of capital or the required rate of return the company wants. Both are same. Okay, so here the arrow is pointing outside because this profit is invested outside. If you have, or if you take these two assumptions, then MIRR can be calculated very easily. Okay, so when you use MIRR, there will be only one clear rate and no confusion. As IRR had multiple answers, like that you will not face. You will have only one MIRR rate and we will not face any confusion while calculating MIRR. Formula for MIRR. MIRR is equal to future value of positive cash flows at the cost of capital rate divided by PV of negative cash flows at the financing cost to the whole power 1 by n minus 1. Here FV is equal to future value of positive cash flows reinvested at the cost of capital or the required rate of return. Now we are going to find out the future value of the positive cash flows, that is your returns or profits which you are going to get periodically from the project. For that you are going to find out the future value at the cost of capital rate. Okay, next you are going to find out the present value of negative cash flows. Negative cash flows means cash outflows or the initial investment. You're going to find out the present value of the negative cash flows financed at the financing cost, that is at the borrowing rate. Present value of the negative cash flows at the borrowing rate in the market. And n is equal to number of periods, that is the project period. Okay, life of the project. Quick comparison of IRR and MIRR. Reinvestment rate. The returns or the profit which you are going to get from the project, if you use IRR, it will be reinvested at the project's IRR rate. Whereas under MIRR, it will be reinvested at the cost of capital or the required rate of return. Number of answers. It will be multiple under IRR, and under MIRR, it will always be 1. Decision reliability. Sometimes IRR may be confusing because there are multiple answers which we get when you use IRR. Under MIRR, it is clear and straightforward because of only one answer. Okay, students, now let us do one probable exam question on MIRR. XYZ Enterprises is considering a project with the following cash flows, rupees in lakhs. Year cash flow. Year 0, year 1, minus 120, minus 80. Since these are all negative cash flows, it means your initial investment. Next, year 220, year 360, year 480, 500, 6, 120. These are all positive cash flows. That means your returns or profits. Given cost of capital is 15%. The cost of capital for the company is 15%. Reinvestment rate, that is a positive cash flows that is going to be reinvested outside, that is also 15%. And financing rate, that is a borrowing rate for negative cash flow, that is also 15%. So all these three are 15%. You are required to calculate the present value of cash outflows, compute the terminal value of cash inflows, determine the project's MIRR. Should XYZ accept the project, compare MIRR to 15%. So they have given the base rate as 15%. And we have to compare the answer which you have got as MIRR to this 15%. If it is greater than 15%, accept it. If it is lesser than 15%, reject it. Okay, this way we are going to do the solution. Dear students, let us do the solution for this question step by step. Step 1 is to find out the present value of outflows. Here outflows are in 2 years. In year 0 happening twice, see year 0 and year 1. So the present value formula will be future value divided by 1 plus r the whole power n. Okay, first present value of cash outflows are year 0 outflow plus year 1 outflow divided by 1 plus r the whole power 1. because for year 1 it is only for 1 year, no, so n is taken as 1. First, year 0 we will take it directly because that is the starting point of the project, that is the present value. Year 1 we are going to find out the present value because it has happened at the end of the first year, convert it to the present value. 80 divided by 1 plus 0.15 to the whole power 1. See, 15% is the financing rate for the negative cash flows. So we are taking 0.15 and n is 1 because it is in the first year. Till here clear, no? Now 120 plus 80 divided by 1.15. 80 divided by 1.5 gives you 69.6. When added with 120, you get 189.6. This is your present value of cash outflows. Now you have to notice that the first 2 years are your investment, 0 and 1 are your investments, and from second year to sixth year are your returns or the cash inflows which you are getting periodically from this investment. Visualizing this will help you to understand how your money moves through the project. Okay. At this point, I want to ask you, if you are finding this video helpful, please like this video and hit our subscribe button because this will support us in bringing you more helpful finance content like this. Step 2 is to find out the future value of cash inflows. Future value formula is equal to present value into 1 plus R the whole power n. Here R is equal to the reinvestment rate, that is 15% for positive cash flows. Okay, for year 2, 3, 4, 5, 6, we have the positive rate of, that is inflows of 20, 60, 80, 100 and 120. For the year 2, 20, we are going to find out the future value for the remaining 4 years because this 20 lakhs was earned for the second year, and we are going to find out the future value for the remaining 4 years, 3, 4, 5, 6. 1.15 to the power of 4. 20 into 1.15 to the power of 4. 1.15 to the power of 4 is 1.749. When multiplied with 20, you get 34.98. Next, for year 3. Year 3, your cash inflow is 60. So for year 3, we are going to have future value for the next 3 years. 4, 5, 6, 3 years. 1.15 to the power of 3 into 60 is your future value. 1.15 to the power of 3 is 1.521. When multiplied with 60, you get 91.26. Next, for year 4, it is 80. For year 4, you are going to have future value for the next 2 years, that is 5 and 6. So it will be 80 into 1.15 to the power of 2. 1.15 to the power of 2 is 1.322 into 80 is 105.76. Year 5, 100. So you are going to find future value only for 1 year because 6th year is the last year. 100 into 1.15 to the whole power 1 is 115. Okay. Next, year 60, 120. 120 is the last, 6th year is the last year. So 120 into 1.15 to the power of 0. Any number to the power of 0 is 1. So 120 into 1 is 120. When adding all your future value cash inflows, you get your total future value as rupees 467 lakhs. We have come to the step 3 where we are going to find out the MIRR. Okay, MIRR formula is future value of cash inflows at the cost of capital rate, present value of cash outflows at the borrowing rate or the financing rate, whole thing to the power of 1 by n minus 1. Here n is 6 years, that is the life of the project. Okay, so we know from step 2 and step 1 that present future value of cash inflow is 467 lakhs and present value of cash outflows is 189.57 lakhs respectively. Whole thing to the power of 1 by 6 minus 1. So first, when you simplify this, 467 divided by 189.57 is 2.463 to the power of 1 by 6 is 0.167 minus 1. 2.463 to the power of 0.167 is 1.162 minus 1, which comes to 0.162. Usually, MIRR will be as a percentage. When you convert it to percentage, that is 0.162 into 100, you get 16.2% as MIRR. We are going to summarize our answer as per the question. In the question, first they have asked you to find out the present value of cash outflows. So we will write the heading as XYZ Enterprises MIRR analysis results. PV of outflows. Step 1. Rupees 189.57 lakhs. Next, they have asked us to find out terminal value of cash inflows. In other words, it is future value of cash inflows. Refer step 2, rupees 467 lakhs. Next, MIRR. Step 3, see, determine the project's MIRR. 16.2%. Should XYZ accept the project, compare MIRR to 15%. They have given the MIRR as 15%. You have to compare your answer MIRR to this. So, decision, accept. As your answer 16.2% is greater than 15% given MIRR, we can accept the project. If you are going to give your answer like this, for sure you will be getting full marks. Okay. We are going to have a final recap of what we have learned so far. IRR is the discount rate making NPV is equal to 0 and assuming the reinvestment of profit and returns at the IRR rate only. MIRR improves decision making by assuming reinvestment of profit or the returns at the firm's cost of capital or the required rate of return fixed by the company and financing of the cash outflows or the initial investments at the borrowing rate. These two assumptions are very important for MIRR. MIRR gives a single, more reliable return rate aligned better with NPV. You can accept the projects when MIRR is greater than the cost of capital. Always understand time value of money, NPV and IRR before attempting the case studies or numericals on MIRR. For detailed understanding, you can watch our previous videos on these foundational concepts. I'll be sharing the link in the description box. Keep practicing with varied case studies for mastery of capital budgeting. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.